Welcome to Tax Insights, presented by Hawkins Ash CPAs.
Hey, everybody. Welcome to the Tax Insights podcast with Hawkins Ash CPAs. We're here with a partner in our La Crosse and Winona office, Greg Kenworthy, and we're going to talk about decisions that a business owner needs to make when deciding whether to purchase a large piece of equipment for their business. So, Greg, the first question I'd like to ask you is, what are some items I should consider as a business owner when purchasing a large piece of equipment?
Yeah, thanks, Kyle. I think the biggest thing when you're looking at purchasing a large piece of equipment is to first determine, if you actually really need it. Just buying something for a tax deduction might be good for taxes, but maybe is not the best move for your business. So I think that figuring out, number one, does this help your business? Does this help it move it forward? What's your payback on it? Those are things from a business perspective, really, that need to be figured out, I think, first. Once you determine that, then some of the tax laws start to kick in. The biggest one that we run into mostly is towards the end of the year when business owners are looking to purchase some equipment. And I think the biggest thing that we tell our clients is that, look, you could buy this piece of equipment at the end of the year, but you really have to have it in your possession, and it has to be, placed in service. It has to be ready to go on your shop floor by the end of the year in order to get the tax deductions for that year.
If I'm financing the piece of equipment, is that going to affect how much I'm able to depreciate it? Like if I buy it using a loan that I haven't paid off the loan yet?
Sure. Yeah, there's no difference. So
Okay.
you can buy it through a loan, you can pay cash. How you finance the purchase really isn't critical at all.
Okay. And then what sort of documentation should I keep on hand when I purchase equipment? Like say I'm purchasing an exemptive sales tax or something like that. Is there something I'm supposed to keep? Or
yeah, I think the most part, just keep the receipt. So you got your receipt or bill sale, keep that on file. If it's getting close to year end, definitely, you like to keep some type of shipping receipt, some type of proof of bill of lading, or something that proves that it got delivered to your facility. Even if we're talking, a big piece of equipment, maybe you take a picture that has a timestamp on it that shows that, hey, this piece of equipment was placed in service by the end of the year, and here's a picture that proves it. All that stuff goes to help.
Yeah, and then if I purchased it exempt from sales tax, I imagine that I need to keep an exemption certificate on hand in case there's a possible sales tax audit in the future. Or
yeah, generally the sales tax issues are taken care of at the point of sale. So generally you're going to want to give an exemption certificate to the party that you're purchasing the asset from. Then they won't charge you sales tax. So that's generally how it's handled.
And then if I'm going to purchase a piece of equipment and then want to use it for personal use some of the time, whether let's say it's like a vehicle. I purchased a vehicle that I'm planning to use for the business, but then, I end up using it for personal use sometimes. Is there any sort of record keeping I need to keep track of for that?
Yeah, definitely. When you're talking about vehicles, you really got to keep track of the miles. That's really what it comes down to. Keep track of the miles. Determination needs to be made up front. Are you going to buy this piece of property through the business, or are you going to buy it personal? Both of them can end up with tax deductions for your business. But the first decision needs to be made. Are you going to buy it personal, or are you going to buy it through the business? Either one is allowed as long as you account for the personal use. And, the easiest way to do that is to track your miles.
So then the last question I have is, let's say I purchase a big piece of equipment, but then when I'm purchasing it, I trade in an old piece of equipment that I have that helps, reduce the price of my new piece of equipment that I buy. How does the reporting go for the piece of equipment that I traded in for the new equipment that I bought?
Sure. Yeah. So these rules actually changed a few years ago. What you're getting at, Kyle, is called a like kind exchange. Basically, a few years ago, the rules were changed so that you can't do a like kind exchange for a piece of equipment. It's still allowed under section 1031 for real estate, but for equipment, you're stuck with accounting for the property in a trade-in as if you sold the property. So for example, if you get a trade-in allowance of say $1,000 on a piece of equipment, it's recorded on the books as if you sold the piece of equipment for $1,000. Then you record on the books the gross sale price of the new asset, and that's what actually hits the books. So it's almost as if when you trade in a vehicle, you trade in a piece of equipment, it's almost as if you sold that piece of equipment for the trade-in value. That's how it's accounted for on the books.
Wonderful. Hey, thanks for taking the time to talk to us about this topic. And if you, the listener, want to receive more information like this, smash that like button and click subscribe for more weekly content. Thank you.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs. Part of your business, part of your life.